Welcome to DACM Insights, where we explore the intersection of traditional wealth management and digital assets. Whether an institutional investor exploring digital assets or a wealth advisor helping clients understand this space, you'll get practical insights from leaders who are actively managing real money in both traditional and digital assets, and the entrepreneurs building the disruptive tech that drives the space so exponentially. Hi, David. Thanks for joining us today.
My pleasure. Thanks for inviting me.
You lead institutional research efforts at Coinbase, but you've got a TradFi background like a bunch of people in crypto. Why don't you just give us a quick overview of your journey and how you ended up in the current role?
Thanks again for inviting me here. So I've been with Coinbase now for about 4 years. And prior to this, actually spent 17 years working in traditional finance. Primarily, I worked in emerging markets, fixed income, and FX. I was previously the head of LATAM FX strategy over at HSBC. But my background when I initially started was actually in quant because I actually studied computer science way back when. And then I got my master's at LSE. But I think that combination of having that kind of technical background, but also having a pretty strong foundation in finance, I think was kind of like why I think I fit in well with, Coinbase. And I think the overarching thoughts behind what's kind of driving this market. So now I kind of look at a myriad of things. I look at everything from what's going on the macro side in the background that kind of drives crypto prices, but also kind of having at least a good sense of like what the technological developments are. Like when we see some kind of big movement in like the Ethereum merge, for example, back in, I think, 2022, like it was nice kind of falling back from my computer science background because then I can understand how that kind of shifts supply demand dynamics, what the technological implications of those things are. So it's good to kind of go backwards and forward to kind of understand like when the idiosyncratic developments really hit the space.
For our listeners that aren't across how research works in a big institution like Coinbase, what's the day in the life of David?
It's not terribly different from what I was doing in my previous life in terms of research. You're always trying to piece together why the markets are doing what they're doing. That's why I kind of like research more broadly. It's kind of detective work a lot of times because you're trying to not only capture what happened in the past, but use that to kind of understand what's going to happen over the next 2 weeks, 3 months, 6 months, a year. And it's, obviously very hard. Like people by nature are very bad at prognosticating. So a lot of times it's trying to like piece together what's relevant in the moment. So we roll it back to like October 10th, October 11th, when we saw deleveraging in the markets. A lot of people had a really tough time trying to understand, like, was it the market makers? Was it one particular exchange? Was it a particular like stablecoin? Like what was behind that kind of move? It takes a lot to unpack. And even like weeks later, I don't think we fully know the full picture on these things, but it's always trying to understand like how those dynamics work so that you can then get a more accurate picture of like what's position now look like. Are we in the clear now? What's the setup? And really like what's the punchline? Because how are things going to look like not just today and tomorrow, but 6 months down the line?
Before we get into the cut and thrust of the current market, just one final question on your background. I saw Stanley Druckenmiller once said, in growth markets, you turn to people that have emerging markets experience. In bearish markets, you look for the people that have worked in the slower growth, lower risk markets like a Euro type approach. Do you think your background in currencies was a good training ground for the volatility you see in crypto?
I think it was definitely helpful. I think because I witnessed that in the emerging market side, I think I understood the value of crypto a lot better than most because I could see, people like using it across, I think the EM spectrum. And I remember that was part of the reason why I think I moved over because a lot of the clients I was speaking to at the time, this was back in 2019, 2020, a lot of them, after we would finish talking about whatever, like, hey, how are markets doing in Mexico or Brazil, et cetera, they'd be like, any thoughts about what's going on in crypto? And I was like, crypto? Why are we talking about crypto? Like, what's this like fascination with it? And I must admit, I was pretty dismissive of it at the time. I was more kind of like skeptical, like I didn't understand how to value this stuff. And even today, I think for a lot of people, that's tends to be the first big challenge whenever they enter the space. But it was definitely a good prep for like kind of being the space now. Like I think a lot of people can't make sense of like how much data there is in the crypto world. Whereas for us in the EM, it was like, yeah, this is old hat. Like it's just kind of dealing with this stuff.
So moving to more local current crypto market thematics, we've seen a lot of turnover at sort of the OG level, particularly around Bitcoin, as we've seen, holders of 5, 10, 5, 7, 8 years of Bitcoin come out of sort of the wilderness and start to kind of disperse their holding. Now, are we seeing a generational change in Bitcoin ownership now? What's driving this?
It's definitely been one of the odder times because I tend to look at crypto positioning from several angles. I look at, for example, perp funding rates. I'll look at how the option skew kind of looks just to kind of know how heavy people are in their short, medium, long term kind of views. But one of the ways I look at from the spot side of things is to kind of look at the net difference between short-term holders and long-term holders. And generally, as short-term holders increases, that tends to kind of point to more accumulation coming from that cohort. It's not really doing the job right now. And part of that is because of the long-term holders. We are seeing that OGs have been taking profit on a lot of their Bitcoin positions. Although I shouldn't just say that that's the only reason this is happening. I think that typically people look at, long-term holders kind of selling their position and they just assume that it's profit taking. To some extent, that's not entirely wrong. Some of these guys made like 10,000x, 1 millionx on their investment. Like there was one prominent OG like wallet that, like he bought Bitcoin back when it was like $30. I think that was his cost basis. So, I mean, he's made several times over his initial value from back when he bought it, I think back in 2011. So it makes sense when you kind of bring these things up. But that's not the only reason. And I bring that up because I think there are increasing concerns around, for example, is there a threat from quantum computing? Okay, maybe. And if that's the case, how much of that is connected to actually being inside of wallets that are vulnerable and needing to move out of those wallets? So just because you're seeing movement from these wallets, it doesn't always mean that people are actually net selling out of their position. They could be doing that for many different reasons. Some of them, for example, are also switching from holding the Bitcoin natively to actually buying the ETF. It's made sense for them at this point in their lives to actually just put it as part of the brokerage and actually including it there. So I would say we need to kind of just caveat that this is not always as crystal clear as people make it out to be. A wallet moved. Okay, this is clearly dumping on the market. Not 100%, but certainly what we have seen to some extent over the last few months is that there's been more selling from this cohort of long-term holders than there was previously.
And look, I guess one of our theories is that you see these ownership transitions as you see liquidity increase, right? Like we've seen liquidity increase materially around the launch of the US ETFs, and then we've seen liquidity and turnover increase materially when we've seen the digital asset treasury growth through sort of the first half of this year. Interesting chart we've seen is if you look at sort of OG moves in terms of Bitcoin, they actually match up pretty well with those two kind of new forms of liquidity, right? So I guess it's, you think it's correct to think about, selling matches buying, right? And as we've introduced a whole bunch of new buyers to the market, and surprisingly, we've sort of coaxed a whole bunch of new sellers out of the market. Do you think that's a framework that makes sense?
Yeah, I think that this is what we're going to see probably moving forward. We're definitely in a new cycle, I would say, for Bitcoin. Many people often use the framework of are these 4-year cycles that were Bitcoin. I've always kind of pushed back against it. One, I never thought that there's too much credence in it, given that there's so many other things that could be pressuring either buying and selling in Bitcoin. And a lot of that has to do with the macro world. And now, for example, some of the previous Bitcoin halvings coincided with, Brexit in the UK or with the US government shutdown. And probably the accumulation of Bitcoin around those periods, probably had a lot to do with the macro context of, hey, maybe I need to diversify away from traditional financial structures. But certainly the new forms of liquidity that you're kind of talking about means that probably the previous multiples that people saw in terms of can we get a 10 to 100x multiple on our Bitcoin holdings probably aren't going to be there anymore. I think that there's going to be much lower multiples now that we're seeing the institutionalization of Bitcoin. It's still going to be more than what you're going to be getting in traditional finance. TradFi, you'd be happy with a 20% return, for example. I don't think that's going to be the case with most crypto, and definitely I don't think that's going to be the case with Bitcoin either. But certainly the multiples are going to be much lower than they were previously. It's a new equilibrium. But the fact that you're still seeing that some of these OGs are selling into the market and the Bitcoin could still absorb that $1, $2, $5 billion of selling pressure with still pretty low single digit moves, I think shows that even with that new equilibrium, I think that this is a maturing asset class. Bitcoin still continues to be one of the large wealth creators in the financial spectrum.
David, you brought up the cycle there and your skepticism over the 4-year cycle. One thing you got pretty right this year was calling the 2025 bottom of the market. What was your framework around that? Like, how did you come to that conclusion and get that call right?
Thank you for saying that. I mean, I'll put it this way. My big call was that we would see like the lows in the first half of the year, and then we're going to make new all-time highs in the second half of the year. To some extent, both of those things were true, except that where I got it wrong was I thought that we would make that new all-time high, which I think we saw in July, and then I think we saw it again back in early October. But I thought that it could be sustained to some extent, and we didn't actually maintain that. So my framework, I think I really operated on, the macro backdrop and how much liquidity was kind of coming into the market. I really think that if you're going to pay attention to one macro indicator, liquidity has been the big one. And when we measure liquidity, we tend to use a custom global M2 liquidity supply index, or money supply index rather. And what I mean by that is typically people take a very naive approach to this and they just kind of take global M2 and they just say like, okay, we add it all together and this is what it compares to Bitcoin or crypto. This is what you should be tracking. And that's not really the right approach. What you should be doing is, number one, you should be weighting more heavily the markets where crypto is being traded. So that's what we do with our custom index. We actually say like, okay, this is where the pockets of liquidity are that are most relevant to crypto. And then we also say like, we need to lag it properly, meaning we're not just putting our finger in the air and saying like, oh, this chart kind of looks right because if you lag it, like over 30 days, it seems like it's matching. We actually run a regression to kind of say like, okay, if we compare it from like 1 day lag over like a 200-day lag, what is the highest correlation coefficient? We land on around 110 days, which seems to be the right lag. It actually has been a great indicator over the last, say, 6 weeks to 2 months, because when we first looked at this back in early October, for example, it was pointing to liquidity tracking lower in November. And we were saying like, okay, it looks like liquidity is going to start going lower from like, somewhere around mid to early October, all through like early December. But it's weird because if I just look at macro conditions, they still seem to be fairly decent. Which one is right? Turned out liquidity indicator was right. We should have just been like following that like all along. The good news too is that it's deflecting higher in December. So we're coming out of that, and it seems to be playing out with respect to that as well. So I really think that, this also kind of coincides with where I'm seeing, for example, liquidity thinning out in late November because of the U.S. holidays around Thanksgiving, people having very much mispriced like the Fed rate cuts. And the end of QT on December 1st, for example, I think that a lot of that liquidity injection is kind of coming back into the markets. So I think that this is all kind of happening at the same time, which is going to lead us to a very decent correction as we enter December.
And do you see that as a broad-based correction, or is Bitcoin the key beneficiary of this liquidity?
Probably going to be more anchored on Bitcoin, I'll be honest with you. I mean, this was a tough part about what happened in early October, because in early October, we saw that many of the altcoins were the ones who were wiped out. They took a lot of the pain, 50 to 70% corrections. And even with that, it was really hard to find a buyer in the weeks afterwards. Whereas I would say Bitcoin, you still have institutionalization. We just saw the headline about a week ago that Vanguard is now allowing their clients to actually access to the Bitcoin and crypto ETFs, for example. So I think that those kinds of themes are still playing out, but tends to be anchored and tends to be more supportive for Bitcoin and not as much on the altcoin side of things. I think probably for that buyer to kind of come back in, I think we need to see more of a correction, and that will still take time. I think that probably when I say I expect that, Bitcoin, for example, will recover over the course of December, I'm thinking a grind higher. It's not going to get back to the all-time highs that we saw in early October, for example, but definitely it's going to be directionally up. And probably it's going to continue as we get into the first half of 2026.
One of the things we've seen is, we get more institutionalization in the market is, periods of much higher correlation between crypto and equity markets, for example. Do you think that's a cyclical or structural shift?
I do not think, structurally, Bitcoin and equities do not tend to be correlated. But I think when people are actually paying attention to the correlation, it's because there are reasons why that spike up happens. We saw that in 2022, for example, when the Fed was hiking rates by 500 basis points. Like, there are reasons why it happens. But typically, when you're talking about the correlation between Bitcoin and equities, I mean, it's capped at the 0 to 40% correlation coefficient levels. So, i.e., like if it's sub 40%, typically it doesn't have a very strong relationship. But I think that during periods of extreme stress, and I think that people don't fully understand why, like I will say that when we're thinking about it, just because the correlation goes up, it doesn't necessarily mean that the source of that pressure is the same. What I mean by that is I tend to think of Bitcoin as a hedge for excess money supply, like excess liquidity. And as a result, like when we see that liquidity get squeezed, Bitcoin tends to be affected. But at the same time, like they're the same forces that cause that squeezing of liquidity can have pressure on the borrowing like dynamics or the P dynamics of companies and stocks that also cause like equal amounts of pressure on that. So it looks from the outset that the correlation is going up, but it's kind of like having a hurricane go through a town, right? Like your hurricane goes in, your house gets destroyed, your car gets ruined. Um, different dynamics because like the house has other stuff that's going on, but they both get destroyed equally. You often say like, man, I don't know what the correlation is between that hurricane or my car and my house, or do you just say no, a hurricane went through town? Typically, you just say a hurricane went through town, and I think that that's what I want to mean when I say that. Like, I often like cringe when I hear people kind of say like, oh, is the correlation going up on a structural level? No, it happens for very, very discrete reasons.
And in your experience, is that one of the key benefits of Bitcoin? Institutional allocators see it as that sort of uncorrelated asset that can add at a portfolio level their overall returns?
Yeah. I mean, like, I think a lot of people look at, portfolio construction and they kind of like think of it from a sharp ratio perspective. And that's how we're all trained in TradFi. First of all, I do not think that for a momentum asset like Bitcoin, sharp ratios are the best way to kind of capture risk. I don't, by the way, think that it's a good measure of the risk reward in traditional finance either. I don't think it really works well when we're thinking about traditional portfolio construction and we're thinking about equities. I digress, because that's the one that we've been using for a very long time. But when we think about portfolio construction and diversification, that's where you see adding Bitcoin to a portfolio. That's where it really shines. We did the math on this. Like if we actually model it out and we add like 1% to 5% of your allocation on a 60-40 portfolio or 60-40 equity bond, portfolio, then you can see that actually the increase in the diversification benefits, i.e. when you look at measure the residual risk in your portfolio, when you add Bitcoin or crypto to your portfolio, it actually increases exponentially. And I think that's not appreciated enough. I.e., when you add like 1% Bitcoin, your diversification benefit is somewhere around like 1.5%. But by the time you get up to like 5% Bitcoin, your diversification benefits are 67%. So I would say that it increases very rapidly as you add Bitcoin to your portfolio. And that's what you're getting from it. Oftentimes people will say like, well, like my stocks are doing well, but Bitcoin's not, or like Bitcoin's doing well, or my stocks aren't. And I'm like, yeah, because that's what you want from diversification. That what like people are like people want it all to be going at the same time. I'm like, no, but this is what you were looking for. If you wanted diversification, then you wanted like these things to kind of offset each other, and that's what you get when you're adding crypto.
The other key thematics of 2025 has been around stablecoins, stablecoin growth, and Coinbase, you have a great position right at the coalface. And the USDC relationship. Your forecast, I think, is around about 1.2 trillion by 2028 for stablecoin supply, and for viewers, it's currently a little under 300 billion in terms of total supply. How are you feeling about that forecast as we sort of go further through the 2025 and look into adoption around 2026?
I think we're on the lower side in terms of expectations because you hear guys like Jeremy Allaire, CEO of Circle, for example, and I think he's calling for perhaps like 3 trillion, 2 or 3 trillion. I'm not sure. Like Scott Bessent has also like similarly like thrown out like numbers as high as like 2, 3 trillion. And by the way, I'm not like trying to nitpick on this. I think that oftentimes the framework that people use to think about the growth of stablecoins is they kind of look at the, M1, M2 money supply in the US, for example. And I think M2 right now is somewhere around like 21 trillion. And they say, all right, like, let's assume like a certain percentage of that, and that gets us to around 2 trillion. Nothing wrong with that. That is not our approach. So what we do is we actually ran a Monte Carlo simulation, about 10,000 Monte Carlo simulations actually, using a simple autoregressive model. And what we kind of emphasize is the 2023, 2024, now including 2025 period is a lot more meaningful when we're thinking about the trend, in part because things have changed, right? Like we had Genius Act, which was signed in July of this year in the US. DICA, of course, like stablecoin rules have been in effect since the end of last year. Like beyond just the regulatory environment, people are using stablecoins in very different ways now. I mean, you and I are probably familiar with it, but most people don't realize how much of this stuff is being used for remittances, cross-border payments, payroll. I mean, like the use cases are definitely expanding now. So we emphasize that makes a lot more sense. And when we kind of run our scenario analysis on that tells us that the midpoint of the range is somewhere around $1.2 trillion by 2028. But it is really hard to kind of map out this stuff and really estimate it. That's why we say like this is a range. We take one standard deviation on either side of that. But the midpoint of the range is somewhere around 1.2 trillion, which I already think is entirely meaningful. But then also, the question arises, do we have enough in US T-bills to kind of absorb this? If not, like, is this going to have undue influence on the curve, for example? Are we going to see that, like T-bills are going to move like 4, 5, or 20 bips, like up or down? And the answer is no. Like, first of all, like we also modeled that out to see like how much would would U.S. Treasuries, how much would new T-bills will we actually have to issue in order to absorb this, and like how long would it take for the effects to actually dissipate? And over a course of like 3 or 4 weeks, let's say a 4 to 5 bips kind of move on those T-bills could actually be absorbed by stablecoins and stablecoin issuers in a way that wouldn't create sufficient volatility on that market.
Like a different angle than I usually take. Is there a bear case for stablecoins? It sounds like you're at the bottom of the market compared to some other forecasts that are out there. What is the bear case for stablecoins? What could go wrong in your prediction?
So we are just taking a more conservative approach. I mean, like, it's really, really hard to actually estimate this kind of stuff. So if, I'm not privy to all the models that are out there and other things, I just happen to know that some of the frameworks that people are using, I'm like, all right, I'll pick on it a little bit because I want to actually think about this stuff and I want to put out in the world having a real mathematical approach when we're thinking about this. So, this is kind of why I emphasize our approach. But what's a bear case? I mean, like my bull case is that this is going to become a lot more ubiquitous and a lot more people are going to use this stuff. But the challenge is that we're also seeing potential for fragmentation in the market because there are newer L1s that are out there, layer ones, excuse me, because, ARC is being like made by Circle. You see Stripe incubating like Tempo. And we understand why this is happening, right? They want to have more control over the rails on which their stable coins are kind of running. They also want to capture more of the value. Maybe they don't want to put their tokens or their stable coins on a competitor's network and have their competitor actually like capture the value instead of themselves. So the issue is, could there be a challenge where like you or I are trying to like spend just the money in our crypto wallets, and I'm like, crap, I have 20 different stable coins in there. I want one. I don't want like this level of fragmentation. I think that there is that potential issue. Now, very likely, we're seeing that already many of the stablecoin issuers themselves are trying to resolve that. I think that by the time like we're talking about this time next year or 2 years from now, like this won't be an issue, but it could be a problem for users in the very short term who do want all this complexity abstracted away.
One of the other thematics you've been focused on is around the tokenization of assets. We've seen ETFs, electronic trading start with skepticism and end up with huge acceptance. Is tokenization going down the same path?
Tokenization is definitely one of the big themes I'm looking at. In fact, I am currently writing our year ahead report as we speak, and I'm thinking about 2026. And I think that tokenization is going to feature very prominently in that. Now, we've so far seen that tokenization has had these fits and starts over the course of the last few cycles. Like it was a big theme in 2017. Everyone's like, oh, this is going to change everything. And people were thinking primarily about tokenization from the point of view of like real estate and other things. Didn't necessarily happen. It happened again in 2021. And then 2022, and of course, it right into the wall of like higher interest rates, like not just in the US but globally. And I think that it kind of got stalled again. But definitely it has since, I think, really gained a lot of traction. And part of that was actually because of those higher rates. I think people who were sitting on borrowing capital at T plus two and, having to pay 5% started to see like the benefits of the efficiency gains of actually having tokenized treasuries or tokenized money market funds. I think now that we're actually looking at a change of the regulatory environment as well, the idea of tokenized equities is definitely a lot bigger than where it was previously. And this has been pushed by Pact Finance, though, even like one of our competitors, Robinhood, like we're seeing that like all of them are pushing into the field of tokenized equities. NASDAQ has actually filed to actually trade 24/7 with tokenized equities as well. So I think that this is going to become a very big theme. And I think that for anyone who's probably listening to this, they know what the benefits are. But beyond just the idea of like atomic settlement, how cheap these things are, I think that what we need to think about is how this is going to transform the the traditional finance landscape. Because previously, if you have a lot of these assets as collateral on your books, there's a reason why it takes time to settle. There's a reason why your like loan to value capture is actually at a ratio of like 50%, for example, whereas you could do it at like 80%, 90% inside of crypto, in part because of that atomic settlement, in part because once you actually have it, you actually can sell the stuff faster. You can actually like not be at counterparty risk as much. So I think that those things are going to change how we actually do business in the traditional world. And B, I would say that from a retail user perspective, I think now you're starting to see the inclusion of all this other stuff that you had previously. I think private credit is a big one, for example, but like all these other assets that, typically not a ton of liquidity inside of them, hard to market. I think now it's going to be a lot easier. It's really going to change the way how you use your portfolio. For example, like now if you want to lend a lot of your equities, for example, it becomes a lot easier. It can be happen a lot faster. And again, if you can do, like instead of having an LTV of like 50%, you can do it at like 89%. Think about how much efficiency that unlocks. It sounds like it's just 30%, but the efficiency unlock is like 3 to 5x. So I think that is going to be a huge change in the way we do our day-to-day finances.
Yeah, I think one of the sort of things we've been looking at as a firm is, crypto's graduating from the sandbox into the real world of, billion plus users and the real money wallets in the world. I think one of the things I find interesting around tokenization is crypto's kind of proven up the use case and the initial demand. We've moved to that step now where the rest of the world can start to see some of that sort of demand. But I think the supply side's also super interesting, right, in terms of the actual cost out potential through tokenization. We've both worked in big financial institutions where, top line growth is hard to get. If I put a technology in front of a bank that says, you can make 3 or 4 times the margin trading a tokenized stock than you can an actual stock, that's when you get the real supply side push, right? And you get both sides of the market coming together. Do you think that's the right sort of framework to look at it with?
I think so. And I think that's absolutely why you see a lot of banks and other financial institutions kind of stepping into the space. I mean, let's be clear too. It's probably because they see the actual like, the money that like, they could potentially be making on this side. Like you take something like Tether, for example, and I think that like last year they earned something like, $14 billion. Like, you talk about like your average like investment bank and they're
Yeah.
making like 6 and like,
Yeah.
like it's $14 billion over like a staff of like 100, 200 people versus like 30,000 people. So I think that they're kind of looking at this and they don't want to leave money on the table. And they're kind of also looking at how much they could actually improve their own, like the downstream kind of services. So I think that this is absolutely one of the reasons why a lot of the institutions are starting to step into the space.
But you've written a bunch about a K-shaped recovery. Can you explain that to our listeners and how that plays out?
This is not a new concept. I think that it came into like prominence during the pandemic as well, where we're thinking about the K-shaped economy primarily from the perspective of like whether flows are going to the higher incomes or like versus like lower income people. And the bottom line is like basically the way wealth creation is kind of set up in most developed countries, it tends to accrue to people in the upper tiers. Like in the US, for example, the top 10% of the population owns 89% 87 to 89% of all of the risk assets available, i.e., like stocks, property, things like that. And this has been one of the primary buyers of crypto. But also, what we're seeing now is that AI is starting to change things. For some time now, I was talking about like how AI was going to improve the productivity in our world, and that stats that we're getting from the US Bureau of Labor Statistics, for example, are just not doing justice. It's not accurately capturing how much efficiency unlocks we're actually getting. Productivity runs in like 15-year cycles. It doesn't just kind of happen in fits and starts. Once it starts going, it actually continues for a very long time. The last cycle ended about 3 years ago. We're in the start of a new cycle, coinciding with a period where AI has really started to become a lot more prevalent. Still, though, like AI is only being used by 40% of people that are out there in terms of the latest like JD Power and Associates like statistic. But what's interesting is that, of course, we were expecting job displacement to come from all of this. And it's happening. Like you probably are seeing the same headlines I'm seeing. Okay, Amazon is letting go of like X number of people, or Tesla's letting go of people. Like basically the high-end like financial firms and tech companies are all letting go of people because they're making such like vast improvements, vast efficiency gains from AI that they don't necessarily need that staff anymore. But think about what that really means. Because typically when you see those layoffs happen, generally it's when those companies are not doing well. We're in a world now where these companies are doing very well. They're making a ton of money because of AI and because of other things, and they're letting go of people. So, like it's creating this weird dynamic, and it's feeding that K-shaped economy that I'm talking about. Because on the one side, like these companies are doing well, and which is why these AI names in your portfolios, like all these stocks, are also doing well. But at the same time, like you're seeing white collar workers, middle management starting to kind of lose jobs. And we're kind of at the tipping point now where like, could this be actually causing distress in people's ability to spend? And if that's the case, what's going to happen to the broader risk market? Because do they have the discretionary income that they need in order to continue buying crypto and stocks and other things? For now, it seems that the benefits that we're seeing on the tech side of things continue to be supporting these markets. And, it makes more sense that if there's liquidity flooding the market and you need to kind of keep pace with that, you probably want to actually be invested in this. And if we try to do a simple analysis, by the way, it doesn't really work because you don't have enough data. There's only about like 36 data points, like i.e. 3 years worth of monthly data in order to kind of run a correlation. But it's still showing you that the correlation relative to like what we're seeing in terms of performance on the like crypto and stock side of things, fairly low. Like the correlation coefficient somewhere around like 0.2. Like it's kind of like nothing, 0.2%, I should say. Over time, we will see some of those dynamics kind of play out. But I think that one of the bigger themes that I'm going to be looking for in the next few years is whether the K-shaped economy is actually going to transform how people actually spend on risk and how they kind of treat their portfolios.
Okay, thanks for joining us today, David. It's been great to get your views across a whole bunch of thematics and where the market's come from and where it's headed. What's the best way for people to follow your thoughts?
Yeah, so they can follow me on Twitter. I am at David Duong, like all one word, except it's a one where the I should be. And otherwise, you can find me on LinkedIn.
All right, thanks for joining us, David.
Thanks so much. Thanks, Richard.
Thanks everyone for listening to DACM Insights. If you found this interesting, please sign up to receive our weekly newsletter, and there'll be more of these coming as we look to introduce more projects that we find interesting across the crypto space to all of you.